All right, so the markets took a breath. What a big day Friday. We talked about that in Friday's Market Outlook video. A lot of technical signals on opposite ends of the spectrum. Exhaustion on one end, breakout on the other. Quite a few. And so today, not surprising, we get a little bit of a breather. We talked about in Friday's video how important it was. We did not fill in any of the gaps from Friday. And so far, despite the weakness today, so far so good. So we're going to break down today's moves, what was kind of driving today's moves in its weakness in terms of like, when I say weakness, I mean like not really moving anywhere, not really trending anywhere one way or the other, not building on what we saw Friday, but also not reversing it yet either. So, what are we going to see now for the rest of the week? Are we going to build on this and really get going, or are we going to end up reversing it? So I'm going to show you kind of what I think and why, and looking at the different charts. And then we'll take a look at what's moving and the different asset classes and why bonds hold the key to all of this. So we'll take a look at that. And then our trade idea is a stock that's kind of in this metaverse that's been so popular here lately with Apple and Meta and what's going on there. So we're going to take a look at how to trade that stock in light of what's been going on here lately. So let's go ahead and get started. Today is Monday, June the 5th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hey, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click the thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. That's why we always ask for it every day. Our goal is to get to 100. We came really close again. We've been in the 90s. So for those who do like us day in and day out, thank you very much. For those who don't, that you can do right now with one or two really easy clicks, and we can get to that goal of 100 likes on these. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator, like we always do. Again, you can see a day after getting the cluster last week on Friday, on the daily and the weekly chart, no less. We're down today, small, very, very small down day, very small range, relatively speaking. So nothing too concerning, not in the least bit. Again, not until those gaps get filled in. We'll talk about that more here in just a minute. In terms of what the market forecast is showing, the momentum line is down to bearish territory. Did not dip into the oversold levels yet. The intermediate line still easily in the upper reversal zone, so the posture is still strongly bullish. You got the dark green shade and green line. We're more than nearly 3%, so more than the 2.5% above the 30-day moving average. So we're still strongly bullish, regardless of a small little dip here today. The NASDAQ, of course, did not dip. It actually went up today. It's finished with a small gain, though again, small range brought the momentum line down as well. The near-term line still in divergence mode. You can see the potential lower highs developing here. We already had a divergence developing before. Now you're still getting an even more lower high point on the near-term line, and unlikely to stay with the momentum line already down and not really getting very far. Unlikely to stay in the upper reversal zone for very much longer. That's the problem when you don't get a strong momentum push, kind of like that breadth thrust, kind of like a thrust signal. Here's where the issues were today. So the Dow Jones Industrial Average so far has not followed through. When you get a bear tag, you like to follow through on it and stay bullish. As of right now, that's not the case. Now, it's not over. The day's not over. This was a little bit bigger of a decline than what we saw in the S&P. But, again, for example, here when you got this bear tag, you just like to keep going, right? Just keep pushing higher and get above and get going. And that's obviously wasn't the case so far, right? And again, we've kind of had some, we had a little down day there and we kept going 2 days later. We had a little... they got the bear tag, didn't get going, got another bear tag, and we did keep going. got this bear tag, and it kept going. So far we didn't keep it going, but we're also not bearish either. The near-term line is still in the reversal zone. The intermediate line is actually crossed now above 40, so we have the light green shading and the green line out of bearish territory. So that's a relatively good sign. And then look at the Russell 2000. Again, intermediate line's not as strong as NASDAQ and the S&P. It was a strong move higher on Friday. And then you can see so far, I mean, again, we didn't reverse it completely, and we were down more than 1 1/3% on the Russell 2000, so a much bigger move to the downside than what we saw in the other indexes. But as of right now, still okay. Remember, it did not get a bear tag because it's already dark green shading in a green line. You only get the bear tag when it's light green shading in a yellow line. That combination is what produces that bullish signal. So as of right now, again, it's not the greatest. We didn't follow through, but it's also not the end of the world either because we didn't fill in the gaps, and that's significant. And when you look at the weekly chart here for the S&P 500, you're getting another higher close. Again, remember the size of the candles are not very big, and they're okay, but it's the smallest move higher than what we saw over here than any of these other rallies. The August rally, this October-November rally, the early part of the year rally, even the March rally had bigger candles than what we're getting right now. This rally here kind of started off with some pretty decent sized candles, still the smallest, but now it's even smaller and it's kind of diverging there. So that's not necessarily the best sign from that regard. Of course, your Dow Jones Industrial Average finally is getting a bullish candle after so many transitions. Right, we were bearish transition. As of right now, this would be a bullish reversal. So that's a good sign. If we can hold this, really good sign. Let's take a look at the 3 green arrows. So we still have the 3 green arrows. We're 2 days in. If we can really kind of solidify it, 2, 3 days, 4 days, as I mentioned on Friday's video, if we can finish the week with 3 green arrows like we've had on the S&P, it's been kind of broken up, but we've pretty much since August or March we've had 3 green arrows with only brief spurts of 3 red arrows, and then the NASDAQ you have even more time with 3 green arrows, and that started in the middle of March. Again, brief spurts of 3 red arrows that are just buy signals. So here, that's not been the case, right? We've actually had, the pink shading for quite a bit, a lot more on the Russell 2000. So now the question is this going to turn into what we see in the NASDAQ, or is it just going to be 1 or 2 days, right? As soon as we get back below, the MACDs are pretty high. Stochastics can turn down at any minute and turn red because they're not in the reversal zone. So you can get a red arrow on the stochastics really quickly. You can get a red arrow back on the moving average pretty quickly. So those are things to kind of watch for over the next couple of days. Of course, if we do that, that means we're filling in gaps, right? The S&P would be filling in its gap if it gets down to below its moving average. You're above the value area for the past year on the S&P. It's a strong move. Again, you're at the 62% retracement. So is the Dow, so is the NASDAQ. All of these indexes, except for the Russell, are at the 62% retracement of the correction that we've been on. So we're past the 50% at least, but we're hitting our head up against this. And the same with the S&P, we're also got that the August peak that we haven't quite cleared yet, like we have on the Dow and the NASDAQ. But we are still bullish. We're way up above the 17-day moving average. The MACD is easily up above its moving average, and the histogram is still rising. So strong momentum in that regard. You see the same thing on the diamonds. Strong momentum with the strong volume we had on Friday, and again at that 62% retracement. The question is whether we get through that or not. Let's take a look here at some of the other oscillators on the chart. So the S&P remember Friday's video. If you didn't watch Friday's video, the theme of the video was the extremes on the S&P and the NASDAQ, the exhaustion signals, quite a few, this being one, and then the breakout signals on the Dow and the Russell, and whether or not they will lead and keep the S&P and the NASDAQ kind of grinding higher, or whether the exhaustion signals will kind of create false breakout signals on the Dow and the Russell 2000. That's going to be the battle for this upcoming week that we're on right now. The ADX is finally climbing up above 20. Actually, should be some light green shading right now. So we'll see if and when we finally get that to show up on the chart here. Because the ADX is above 20 with the positive cross, with the positive line well above the negative. So a good pattern for the S&P in that regard. Looking at the Russell 2000 or the RSI and the CCI, again, not the strongest patterns. You're getting a divergence on the CCI with the higher highs and the lower highs. Your RSI did not make it up above 70. Not like the NASDAQ 100 did, and NASDAQ 100 still is above 75. So the NASDAQ 100 is still at extreme levels on the RSI. It's also at pretty strong levels on the weekly RSI, and about as strong on the peak on the CCI has coincided with peaks in the NASDAQ in the past when you get these strong levels. When you've been on this bearish trend. We'll see if that changes now that we're on a bullish trend. But you've got the combination of being above 200 and the RSI being above 70, again, is another just extreme sign of bullishness for the NASDAQ 100. In this case, long-term bullishness there. Let's take a look at the whole. We haven't looked at that here in a while. The great looking candles, again, yesterday's candle. I think I did show this actually in the Friday video, how big it was. Again, it's one thing to get this size when you're starting a run like we did over here in May. This current run, we've had this bullish move now. In fact, we've been green on the line, except for one day. We've been green for quite a while here. So it's not the best sign to get that big candle, when we've been mature. Versus when we're very first starting, because that's when you get the big candles to the downside, you tend to follow up with big candles to the upside, and that starts you going. And that's obviously not the case here. We're not coming off of big candles to the downside to get these big ones to the upside. So big moves, and you can see the parabolic stars really going parabolic and catching up. That's the S&P. If you look at the Qs, it got the big candle just a few days ago or last week. Really, really big up bullish candle. Again, not at the beginning. And we've kept going up, but you can see it's been getting a lot smaller, the candle size. And we're starting to converge a little bit with the PPO, with the 200-day haul. So that bears monitoring. The diamonds, you can see we did get the big candle right at the beginning of a new move, right? That's what we want to see. Big candle there, and now we've got the higher close so far. Didn't get very much of a higher high, but we got a higher close, and now we'll kind of watch to see how that develops again over this week. Your SPY on Friday closed way outside the bandwidth and the Keltner channel. Typically bullish again when you're starting a bullish trend. Doesn't look like we're necessarily starting a trend here, and we're not breaking out above any resistance there either. You did get a green dot, so for the first time in a while you've got a green dot. So the bands are outside the Keltner channels. We've been that bullish. Of course, the Qs is looking the exact same. Still has been above the upper Keltner channel for quite a while. The diamonds still are not. In fact, you got into the upper quartile on the bandwidth on Friday, and then just like that, you're barely staying in it. And again, you're not strong enough on the push to push the bands outside the Keltner channel so we can get trending. So again, goes to show just how the lack of strength that we have. We got the intermediate trend strength on the S&P. We don't have any kind of trend whatsoever going on the Dow. In fact, whatever trend we had on Friday is gone today, with both those indicators dropping to zero today, just like that. So, I mean, that's not the best follow-through on the markets of what we'd like to see. The breadth looks so good on Friday. All these breadth indicators, it stunk today. So it came back down below the positive 35. And we got to get above positive 35 and stay there to get a good trend going. You're all the way. Remember, we have a negative summation index, so not necessarily in the best position to begin with, and we're already back below plus 35. Now we're not negative, but we're already back below there. I mean, you look at like new highs and new lows, and it looked like we were going to really break out. You're really going to break out here. We didn't break out. In fact, we're just at 72 now. So we're back below positive 100. I mean, again, I think we forget because it's been so long what it looks like on the new highs, new lows index when you're actually bullish. Let me go back for some context on what this index looks like in a bullish trend versus what it's looked like over the last couple of years. And you can see like that's what a bullish trend looks like when you're getting more new highs and new lows. And this is not what a bullish trend looks like, and why we can't get going. Even now, being above the February peak, but that was our best breadth that we've had, and we can't replicate it even now. The ratio chart of the Qs IWM, which had dropped sharply on Friday because of the good breadth, dropped below the 8-day moving average, jumped right back up above it. So right back up to 1.97. So again, back to extreme highs. The long-term PPO, really, really high levels. I mean, we're very extreme. When this chart goes down, it's not the most bullish. The only time it has been bullish is when we've had the reopening, when the economy was shut down. It pulled forward a lot of these tech gains, and then the economy, like with the vaccine, we had the reopening trade took off like a rocket at the end of when the vaccine came out. And that's the only time that this index has gone down, especially this significantly, and the markets were bullish. IWM just went up more into March 2021 when inflation started to take off at that point. So we're not looking forward to this correcting. And yesterday, Friday, was kind of this like, oh, we dropped one day and it was a good day. Maybe that's what we want to see, and it's not traditionally what we want to see there. In fact, I was going to show you the number of stocks above the 50-day moving average dropped back down here. So let me get back to a one-year chart on this. I'm just going to save this so I don't have to do that again. So we're still above the moving average. You're not above 250, and we're definitely not above 300, which is 60% of the S&Ps. But we're back down below the midpoint, still slightly above the moving average. And you can see the 200-day moving average. You're going to actually have a higher number, which is kind of interesting here, because you like to see the number of stocks move up, but you notice we're at 263 right now on the number of stocks above the 200-day moving average. When you look at the ratio of these are S&P. If you look at the ratio of the New York Exchange, the New York Stock Exchange, what percentage of their stocks are above. So a little bit broader level, broadening it out. As of right now, there are more stocks above their 50-day moving average than above the 200. And that's not what we want to see when you're bullish, right? When you're bullish, you want the ratio to be above 1 and moving higher above the moving average. That's how we get going here. But we're below the moving average. We're below 1. Again, that's a sign of bad breadth and typically suggests, you can see as it did at the end of 2021, coming out of that period here where the NASDAQ really outperformed, NASDAQ 100 really outperformed the Russell. They all come because we were below the moving average, that it started to pull back there. So we don't want to necessarily be below that moving average. It typically coincides with weakness until you get to an extreme where the breadth is so extreme that it's actually bullish. You see a lot of other factors too, like the put call ratio is strong. There's a lot of signs of just extremes here in the markets, and that's showing up. And we even talked about the VIX here. Let's quickly show the range today. A higher high and a higher low, but we did not close above yesterday's high nor last week's high. And you see that big gap in volume, how easy it is to go down. That's the concern with the diamonds and the Russell. We cannot fill in that gap. It's going to be a little harder for the diamonds to go down. There's more volume there. And a little harder for the Russell to go down. But you can see if we get into these areas, we're going to be in the lower half of the chart. We're going to be below these moving averages. We cannot fill in. Lower is an inside day today on the Russell. We really need to break back out and not fill in that gap by the end of the week. That's not something we want to see. Right, that means basically nullifies the bullishness that we saw. Low volume, low range today. We did finish again a second straight day below 15. You can see what it looks like there. If you take a look at the VVIX, it was only slightly down. So a bigger move down on the VIX, even though the market wasn't too bullish. In fact, the S&P was actually down a little bit. But you can kind of see what's going on there. The correlation here between the VIX and the S&P 500 had been weaker at this 50% mark, is back down to strong negative levels. So at these extreme lows on the VIX, and you're expected to get a little bit of a bounce here from a seasonal standpoint. Let's look at the 20-year chart. You get a little bit of a bounce here from a seasonal, but we're way lower now than we traditionally are at this time of year. And so again, that we've talked about on Friday that the VIX is actually due for a bounce, for a move, a strong move to the upside. And we've seen it before, and it's due for it again, considering how extremely low it is. And we'll, again, if that happens this week, then it's pretty likely the Dow and the Russell. And that's actually the camp I lean in. I'm leaning in this idea that we are going to fill in those gaps. We can't, right? If we're going to be bullish, we want it to be bull. I mean, we all want the markets to be bullish. We got to keep this breakout signals in the Dow and the Russell. But I'm more in the camp of we're so extreme on the other indexes and the VIX itself that it's going to be hard for the Dow and the Russell to carry what is so extreme in the others to keep them there without the parabolic nature of the move, especially in the NASDAQ, not correcting more significantly to the downside. Considering it's a large percentage of the market from a cap weighted standpoint, then if that parabolic move starts to correct, it will more likely bring the Dow and the Russell down with it, rather than the Dow and the Russell being able to keep it from correcting. Considering, again, like I said, the cap weighted nature of the markets. All right, now let's take a look at what's driving this price action here. And of course, you can see the big 3-month returns and the disparity still persist despite the nice little Thursday and Friday that we had. But let's look at just today alone, how we started off this really important week of holding what we finished with last week. You can see it's pretty much a risk off day in terms of small cap stocks down 1 1/3%. Real estate, which has been kind of tracking with small cap, was down quite a bit as well. And gold was your big winner, even though the dollar was pretty flat for most of the day today. The Qs were up early as they were a safe haven, at least have been. They fell off their highs by the end of the day, as with the S&P 500. Of course, IWM's highs of the day were down 0.8%, not up 0.8%, and you can see it came off of its highs of the day as well. Long-term bonds were flat, so not much of a movement there. The biggest moves again were in gold and small cap stocks, and we've already looked at IWM, right? It's not, it's kind of flirting at that 200-day moving average, seeing if we're going to break through or not. Gold bouncing back up, but still below its 8-day moving average, still below the 17-day, with the MACD slightly above its moving average down there. So in convergence mode, of course, that's going to move in opposite directions with the dollar, which is trying to figure out what to do with this 200-day moving average on UUP at least. Whether it's going to break through that or not. Of course, breaking through that more than likely would coincide with yields rising. Yields did move up slightly higher today, not very much. They were down off of the open. They opened a lot higher before pulling back down. But TLT is the big, it's the big key. I've talked about this before, that usually bull markets and equity start when TLT has had its bull market already. Because it's, again, currencies, bonds, stocks, commodities. That's the order that things go in. So the dollar has had its bullish move, right? There's the dollar's bullish move going into the end of last year. So that would mean that the next bullish move would be in bonds, which would then have the dollar making its bullish move, or the S&P, or stocks. Which means that if bonds are going to make their bullish move, and bonds are so extreme in bear market territory, way below the 200-week moving average, but converging upon the 50-week. So if this were to start to make a run to the upside and start its bullish run, a little bit of an inverted head and shoulders pattern, then you would expect S&P to come after that. Commodities, you can see bonds typically, commodities will start to bottom out as or correct as it's doing right now as bonds start to rally, and that's really been the case. Commodities started to correct at the end of last year, about the same time that bonds started to base. Right, we stopped the decline and started to base at the end of that year. That's when commodities started to correct. They got below their 50-week moving average and kind of stayed there. And now we're kind of flirting with breaking below this, even though a big component of the strength or weakness in commodities will come from what's going on with crude oil. And crude oil started the day really high in the production cut numbers from Saudi Arabia, but then finished way down to the down. Well, finished well off of its highs. Again, the point of control is above us. The 50-day moving average is above us. So we'll see. It's going to be, again, hard for risk appetite to really take off. If bonds are already so extremely oversold and commodities are correcting, and crude oil can't even catch a bid from production cuts, which usually drives it higher, and we can't even get that going. So there's a reflection of weakening economic expectations. You saw that with the PMI numbers today. It's a reflection of weakening economic expectations. Again, and how is that going to impact risk appetite in general? Again, considering the NASDAQ 100, the S&P 500 are showing exhaustion signs, signals Friday and still going into today. Let's look at the sector moves and how they performed here today. So let's zoom in on June the 5th. You can see a risk-off move here. Energy and industrials down with technology and financials. So technology kind of joined that cyclical area down there. And materials is really the only one that performed well. But it came down eventually and underperformed what you're seeing there in communication services and discretionary, kind of trying to hold up. But utilities and healthcare outperformed. So, a little bit of a risk off at that standpoint. You see staples lag, real estate lag. So it wasn't complete risk off, but you get the idea. And technology is not the sector that you want to deviate from it's not the one of these three that you want to deviate, because that's the one that's been so strong and it's the biggest one. It's got the biggest stocks in it. So we want technology to maintain its strength. If you start to see some weakness showing up here after going parabolic, again, that's going to put a lot of pressure on, like energy already back below its moving average, real estate and materials looking close, industrials not building on that strong Friday, and financials never really getting that big of a move. And then you can see staples and utilities still below their moving averages, and healthcare unable to get above that. So we got light green shading, but you don't have a whole lot of yellow lines. You got mostly red lines here. And again, hopefully this is one day, but if this one day of weakness turns into more by the end of the week, I don't think all 5 days are going to go down. I do expect there to be more weakness by the end of the week. And I don't think that we'll be able to build upon Friday's breakout. I think we'll be back in those gaps in the Dow and the Russell. And if that's the case, you'll start to see dark pink shading and red lines across the board here. And I think that it will also coincide with the technology sector and other overbought sectors starting to work their way back down towards support levels, and which is not as good of a thing in these cases because they were so parabolic. When you look at like the technology sector on the DMI, the XLK, I mean, it got this positive indicator, this positive DMI directional index got all the way up to about 50. I mean, that hasn't done that in 5 years. I mean, it really, really went parabolic. Its ADX is not as high as it's been. There's been a few other times the ADX has gotten higher because the negative indicator got so low. Both of these other instances, and even over here, you got the negative indicator below 10. All of those bearish levels. This one is just the positive's gone up so much. the negative didn't drop very much. And you're still, I mean, you're going to get a move. That ADX is lagging, so it's going to continue to move up towards levels where the, probably up into the 40s here by the time it's all said and done. So it's a parabolic move that, again, parabolic moves can keep going for however long they go, but they don't typically correct sideways. As you saw over here, that parabolic move did not correct sideways. Obviously, this parabolic move did not correct sideways, though it had COVID to blame for that. And then you can see this parabolic move here, down here, also did not correct sideways. So that's what we have. That's what we have ahead of us right now. Is those kind of declines like we had in 19, like we had in 2020, and like we had twice in 2020. When the NASDAQ had previously gone as parabolic, or the technology sector, which is a big chunk of the NASDAQ, and a big chunk of the S&P, had previously gone parabolic before. All right, so for our trade idea of the day, let's take a look at Roblox, RBLX. It's been on a pretty sideways move for most of the year. It hasn't really trended. There's been a few bullish trends, a couple bullish trends. There's been a couple bearish trends here. Short bearish trend there, short bullish trend, but sideways for pretty much most of the year. The intermediate line, you notice, is rising, but it's, the near-term line's already fallen back below it. The market sentiment line's still falling, even though the intermediate line crossed above it. But it doesn't look like the intermediate line's going to really take off into that upper reversal zone, not without the near-term line already, getting in there, not without the near-term line staying in there. If you take a look at its weekly candles, you can see really sideways moves, not very much going on here at all. So sideways action going there. Looking at the 3 green arrow chart, you are trading today. You're trading for most of the day, right, like the 8, 17, 50-day moving averages all went through today's range. You ended up closing slightly above the 8-day moving average. The 30-day is still below the 50, and you're not, you are above the 30, but you've been flirting with, not really pushing up. The momentum is gone. Stochastics is actually declining there. So it's not it looks like whatever bullishness we had, which wasn't a lot, isn't it there anymore, and we're starting to kind of trend sideways again with both the DI positive and negative indicators below 25. The RSI and the CCI indicators are right smack dab in the middle of the chart. Almost perfect on the CCI, perfectly in the middle. And then finally, your Ichimoku cloud. You can see that you are pretty much right at the cloud. This is the point where it's crossed over, and you're right at it, and you're not really moving up. There's not very much of a trend. You're below 1. You're below 50. You briefly had a weak. You briefly had a weak bullish trend. Now you don't even have a weak bullish. It's not meeting the thresholds there of being above 1 on the trend quality and above 50 on the noise balance. So there's no trend whatsoever, and you see that in the Bollinger Band width has been declining for a good chunk of time here, and appears to be working towards the low end of its range. The bands themselves have come in after being outside the Keltner channels on this move to the downside and the rebound. You're back in the middle of the range. The bands are inside the Keltner channels. That just kind of screams a sideways move. So let's take a look here at our trade. So let's look at the trade setup here. This was a low 20s delta when we did this trade during the Market Outlook Live today. So we're going to sell the low 20 delta, the 35, buy 30 for protection. Here, this was actually a 30 delta when we sold it during the Market Outlook Live, and then buy that. So we're just a little bit up from where we got in, but not very much. And you can see the full position size for a pretty decent reward. Our break-evens, that's where our break-evens are. So pretty much the entire value area of this past year is inside of break-evens. And you don't have to worry about earnings until after July expiration. So as long as it continues to stay centered around this point of control, then we make, again, for at max $1,000 of risk, but ideally no more than $447 of risk, we can get that amount of reward with a relatively high probability of success. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.